My colleague Amit Ranjan here has also done some research on, especially on electronics manufacturing, and with the government's thrust on Make in India getting even louder, especially with semiconductors capturing India and the world's imagination. Let's see what electronic manufacturing stocks have for us, Amit.
Yeah, so we had picked the story yesterday when Jefferies had gone bullish on certain electronic manufacturing services stocks and had projected almost a 55 to 60% EPS compounded annual growth rate for most of these stocks. Now, this sector is expected to grow by 35% between this year and financial year 2026. Now, the stocks that they had named, Jefferies had named, one was Sryma SGS, the other one was Keynes Tech, and then there was Amber. Most of these stocks have gone into the positive today, but for Amber Enterprises, and there's another stock in the sector which is a very big global player, Honeywell. These are the only two that are not doing so well. Kush, what is the reason why these two stocks, and Amber being named by Jefferies, still in the negative today?
So, well, I think, the fact that, we had seen a long, rather a long phase where, a lot of these names had performed. Thereafter, there wasn't as much follow through, and, every rise sort of turned out to be a selling opportunity on some of these names. Even the fund interest was perhaps, missing in some of these names off late at least. So, and we've seen those corrections, come about. Now, Amber Enterprises, particularly if you see the last couple of sessions, has attempted a rebound. And from a risk reward perspective, I think this might turn out to be a favorable bet. So I think this is something that you could in fact have on your radar from a long perspective, from a fresh entry perspective also. I think the other stock that you mentioned was Honeywell Automation. This is in a bit of a consolidation mode. The stock's been trading below its key averages and key support zones for a while now. I would perhaps give it a miss, even if there is any kind of a positive traction on this one. So Amber does look like a fair risk reward trade. Honeywell Automation, not as much.
And what do you make of Dixon, which has been in the news for more reasons than one? The PLI advantages that they are taking, the China plus one, the story that's going in their favor. Is there still steam left in it, or the 171% gains that it has given over the last 1 year, it's maxed out?
So Dixon is a buy on dips kind of a setup. It had a massive fall, but what is extremely heartening is to see the recovery. The recovery also has been equally sharp. The stock fell to about 3,000 odd levels, even below those, and in the last just year or so, it's actually more than doubled. So this is a very heartening story. Now the setup that we're looking at is making it a little buy on dips kind of a setup, because we're seeing divergences. The price actions have moved, but the momentum really hasn't caught up as much. So it will for sure be on our buy radar, but let's say closer to support levels. If it comes to 6,800 or perhaps even 6,600, those kind of zones is when we will look at fresh entry. From here on, the risk reward ratio may not be as favorable.